All right, today we're going to break down a really simple but incredibly powerful rule that professional traders live by. It's all about playing defense, about survival. It's called the 1 to 2% rule. And honestly, understanding this is what separates the pros from the rest. Let's dive in.
So, let me ask you a question. Have you ever been on a roll? You've got 5, maybe 10 winning trades lined up, and you're feeling on top of the world. And then, bam, one single bad trade comes along and completely wipes out all those hard-earned gains. If that sounds familiar, you're not alone. And the problem isn't that you're bad at picking winners, it's that you've got a hole in your defense.
And that hole, that silent enemy in the background, is uncontrolled risk. It's the one thing so many traders ignore because they're chasing those big, flashy profits. But for the pros, it's the single most important thing they think about if they want to stay in the game long term. And this gets us to a really crucial shift in mindset. You see, while most people are asking, how much money can I make? Professionals are obsessed with protecting the money they already have. For them, capital is their lifeblood. Their number one job isn't to make more money, it's to not lose the money they have. Everything else comes second to that.
So, how exactly do they do that? How do they protect their capital with such discipline? Well, they use one simple, non-negotiable rule that guides every single trade they make, and that is the 1 to 2% rule.
That's it, these two little numbers right here, 1 to 2%. They might not look like much, but these numbers are the absolute foundation of a professional trading strategy. Their real power isn't in the numbers themselves, but in applying them over and over and over again with zero exceptions. So what does this actually mean? It's simple. On any single trade you take, you are not allowed to lose more than 1 or 2% of your entire trading account. That's the hard limit. It doesn't matter how great the idea feels, you cap the potential damage. This way, no single trade can ever blow you up. It takes all the emotion right out of the equation.
Okay, so how do we put this into practice? It's a two-step process, and it always starts with defense. Step 1 is all about setting your stop loss.
Now this is super important. Your stop loss isn't just some random number you pull out of thin air. It's a technical point on the chart. It's a specific price level, maybe just below a key support area, that tells you, hey, my original idea for this trade was wrong. The moment the price hits that level, the reason for being in the trade is gone, and you get out, period. So once you know where your exit door is, you can move on to step 2. And this is the part that answers the question, how much? This is where we calculate your position size.
The calculation is actually pretty straightforward. First, you know your total capital and your max risk. Let's say you choose 2%. Second, you figure out your risk per share. That's just the distance between where you're buying and where your stop loss is. Once you have those two numbers, you can find the perfect position size. Let's walk through a quick example to make this crystal clear. Let's just say your total trading capital is 100 million, and for this particular trade, you decide you're willing to risk the maximum of 2%. You might use 1% on a more speculative idea, but for this one, you're going with 2.
Okay, so 2% of 100 million is 2 million. This number is now your absolute maximum allowable loss. It is your line in the sand. No matter what happens, you cannot lose more than 2 million on this one trade. Now for the other piece of the puzzle. Let's say your technical analysis tells you that your stop loss should be placed 5,000 below your entry price. This means that for every single share you buy, you are risking exactly $5,000. All right, so here's where it all comes together. We know our max loss is capped at 2 million, and we know our risk on each share is $5,000. So the big question is, how many shares can you actually buy to make sure you stay within that limit?
The math is just simple division. You take your max risk, the 2 million, and you divide it by your risk per share, the 5,000. And what do you get? 400 shares. That is your position size. Not 500, not 1,000, it's 400. Because if you buy 400 shares and the trade hits your stop, you will lose exactly 2 million, which is exactly 2% of your capital. The rule is perfectly honored.
So now you can start to see how this all connects. This isn't just about one isolated technique, it's about combining two totally different but equally crucial disciplines to create a rock-solid system. Think of it like this. You've got this perfect partnership. Your technical analysis, your chart reading, that answers the question of where. Where do I get in? And, just as important, where do I put my defensive stop loss? Then, your risk management, using this 1-2% rule, comes in and answers the question of how much? How much capital should I actually commit to this idea? You absolutely need both to trade like a professional.
But really, this is about so much more than just a formula you plug numbers into. Adopting this rule forces you to fundamentally change how you even look at the market. It's a total shift in your mindset.
Here's the difference. The amateur trader looks at a chart and the first thing they ask is, wow, how much can I win on this? All they see is the potential reward. The professional looks at that exact same chart and asks a totally different question. Okay, how much am I willing to lose to find out if my idea is right? See the shift? It's all about focusing on the risk first. That's what keeps you in the game.
So, I'll leave you with this final thought. Look, you can't control what the market does next. Nobody can. But you can always control how much you're willing to risk. And by using this rule, you stop letting luck and emotion run the show, and you start taking control of your own destiny. So you have to ask yourself, are you managing your risk, or is your risk managing you?